So look at it this way, the global liquidity, as we spoke about earlier, that's the fuel that's keeping the economic engine running. Central banks easing, fiscal policies stepping in more aggressively. That liquidity is helping to support consumption, investment, asset prices and global growth. But the tariffs, they're the friction on the road. They're the ones that's what's driving uncertainty, obviously, but raising costs, putting inflation pressures up higher, disrupting supply chains. So even with more fuel in the tank, like liquidity, the journey still remains relatively slow because of this trade uncertainty that's lingering.
This is Converge,
a podcast from Canberra.
Come with us as we shape the future of finance.
Hello everyone, I'm Stephen Dooley, Head of Market Insights, and welcome to the Converge Podcast. And it's a special edition today because we are looking at the launch of our Are You Ready for 2026 research report. We produce this each year looking ahead to the macroeconomic influences that will drive FX markets. And I'm happy to say that today I've got George Vessey, our lead FX strategist located in the UK. And George, thanks for being on today.
Cheers, Steve. Pleasure to be back. Yeah, this report is a beast to produce, but it's one that we genuinely love tackling and see the positive impact it has across our customer base. And looking forward to getting stuck into it.
Yeah, absolutely. That's a good place to start when we think about the impact of the report. And before we jump into 2026, why not rewind to this time last year? Looking back, what stood out, do you think, over the last 12 months in terms of what we were writing about 12 months ago? And where did the playbook that we try to put together for businesses prove especially useful?
Yeah, I think, good place to start. And first off, let's remember that we published the report this time last year, just ahead of the US election. So the election result wasn't known at that point, but we did bake in the possibility of a Trump win and therefore the trade policy uncertainty that would come with that. And that is exactly what's played out. This year, tariffs have become a key risk, of course, and it's triggered major market swings, as we know, back in April, including an over 20% drawdown in the NASDAQ as a prime example, going into bear market territory there. The VIX volatility equity index, that spiked to levels last seen during the pandemic. So it really caused some market disruption. And the tariffs also complicated the Fed's easing path, which is something that we said might happen as well due to the concerns around inflation spillovers, slowing the pace of Fed rate cuts. But we also flagged, Steve, those stabilizing forces, falling interest rates, lower unemployment, persistent global disinflation trend that we have seen as well. That's kind of helped cushion the impact of these trade shocks. So, although growth has slowed, it hasn't contracted, and the US has again avoided a recession so far as well. But let's be real though, the extent of the tariff-related noise has caught everyone, including ourselves, off guard this year, not to mention Trump's criticism over Fed Chair Jerome Powell. But I think markets have gradually adapted to this Trump 2.0, it seems, learning to filter out this noise and focus on the implementation rather than on the headline drama.
Oh, no, you're right. It's been absolutely incredible. And when you think about the year from post-Donald Trump's move into the presidency, his first move to really launch tariff threats on Canada, on Mexico, the impact on those markets, the fact that he seemed to retreat from tariffs on Europe and the Eurozone, which saw the Euro push so strongly higher. And then what we saw around April the 2nd on Liberation Day, it's hard just to remember how volatile and sharp the moves were. It makes me think of a philosophical question that we wrestle with a lot here, that with so much noise from tariff to that central bank tension you were talking about with Jerome Powell, that trying to pinpoint an exact currency level, it's a futile exercise. So what about the way that we approach FX? What are the key takeaways you think from 2025 in the FX space?
Yeah, exactly, Steve. I think we never try to predict exactly where exchange rates are going to go, exactly every twist and turn. You're always going to get it wrong. We see that evidence more often than not. So it's about preparing for uncertainty, not pretending to eliminate it. So, we build ranges around plausible outcomes based on things like trade tension, but also standards like growth, inflation differentials, where interest rates are going to go, but also, policy like monetary and fiscal policy. So as an example from last year, the euro dollar forecast range was, it was around 20%. 0.98 to 120. And, one might have thought that was seemed highly excessive this time last year, but actually it captured the trading band that we've seen almost perfectly. It's only a cent or two off on either end. And also, if you look at our baseline forecasts, they weren't too far off on the Aussie, the Canadian dollars, a couple of cents off when it comes to sterling against the US dollar. So even though we don't like to pinpoint exactly where exchange rates are going to go, I will call out when we are close to it with the baseline forecast, but it's all about finding or looking at the scenario-based approach that we really advocate. And looking back again to this time last year, we did anticipate in a Trump victory that the US dollar might bounce off the back of it, like we saw in his first term, due to the impact of inflation potentially being stickier and the Fed not being able to cut interest rates as much. But we also pointed out that the tariff rollout, once that became clearer, might weaken the dollar. And that is what's happened. That is what we've seen. I don't think, though, and I don't think anyone did, to be honest, see that the dollar or predict that the dollar would depreciate as much as it has done this year. It's had its worst first half year performance in over 50 years, dropping 10% against a basket of major currencies. And that is extraordinary, isn't it? Especially with US growth outperforming and rate differentials still favouring the dollar more broadly.
Absolutely. And that's a topic that we do tackle in the report. I don't think you and I will get a chance to talk about that today, but the way the US dollar fell so sharply, despite the fundamentals, like you say, stronger economic growth, interest rates relatively higher than the rest of the world, they're the kind of fundamentals that typically would drive the US dollar higher. They haven't had an impact this year, and that's one of the real interesting questions, but we might save that for another podcast. But let's think about the year ahead and think about what might be the most important themes you think that might be shaping the FX landscape in 2026?
Yeah, this is the big question. There's obviously loads of global and regional themes that we could have picked out, but to try and provide a bit of clarity, cutting through some of the noise there, we condensed it, we narrowed it down to three big themes this year, Steve. One of them is the evolution of monetary policy. It's something that we pick up on most years, to be honest, because it is so important. Often central banks move in sync. We've seen the global easing cycle that was kind of in lockstep has now started to become a bit more fractured. Central banks, regions are facing different challenges from different inflationary dynamics, facing rising debt burdens, but also the political pressure, as I mentioned earlier, with pressure on Jerome Powell in the US. And that means that rate decisions are becoming a bit more unpredictable. Monetary policy is becoming a bit more unpredictable as well. And so this is making a big shift for FX markets. Again, to reiterate the point, the old playbook of rate differentials driving currency moves has broken down considerably at points this year. So that's something that we've definitely focused or honed in on for this year's report. And then, as you mentioned earlier, we do a deep dive into the role of the US dollar, just because it's such an important topic right now, the kind of disconnect that we've seen with the dollar from fundamentals. Investors now looking at how adaptable a currency is, how well it reflects institutional strength, policy clarity, geopolitical alignment. It's like a new regime that it's reshaping how we think about reserve currencies and diversification strategies. So that's another key theme. And then the third, obviously, it's everywhere, geopolitics. And we're not just talking about wars. We're not just talking about conflict. We're talking about a whole host of things, and it's all intertwined with economics. Trade, debt, diplomacy. They're no longer separate forces. They're converging. They're driving market behaviour in ways we haven't seen before. So, for businesses, that means FX risk is no longer just about interest rates or macro data. It's about navigating a much more complex global landscape.
Yeah, I mean, I love the theme that you mentioned there towards the end about geopolitics and economics converging. It's also really tied in with what we talk about in terms of the traditional geopolitical spectrum around wars and terrorism, how that's become a lot more complex and integrated with governments more generally, how we see a lot more frequent and impactful geopolitical shocks. And it seems to have all kicked off around 2015. And again, one of these topics we'll talk about in another podcast, but there's definitely been a shift as the globalization consensus has broken down and governments have become a lot more interventionist. It's fascinating, and it means that FX risk management is more complex than ever. Today, though, let's think about the big picture. You mentioned earlier that despite everything the world's had thrown at it in 2025, global growth has still remained pretty strong, and that's been a continuation of what we've seen over the last 3 or 4 years. It's also clearly slowing. So what's driving that moderation in growth, and should we be worried going into 2026?
Yeah, I think that's the key point, the fact that we have seen global growth slow down, but there is still resilience in the face of all of this uncertainty, all of the risk events that we've had. So yeah, it's not a collapse, which is a great thing, obviously. Global GDP grew, it was about 2.6% in the first half of this year. So that is down from the 2.8% that we saw in 2024. And actually we were expecting 2.4%. So even softer growth for 2026. Now, again, speak of this resilience, but it is actually going to be the weakest, if that plays out, it's going to be the weakest 2-year stretch since 2009, excluding the pandemic. But it is still positive, and the shortfall relative to expectations that we've seen has been modest as well so far. So we are trying to lean towards the positive aspects of this. But anyway, what is driving this softer growth, this slowdown? Obviously, the main culprit is the trade disruption from the tariffs, but also the fading post-COVID momentum. We're coming off that period of the post-pandemic rebound and the extraordinary policy support. So, of course, a slowdown was going to be inevitable, but especially following the inflation shock that we had, the tighter financial conditions that we've had since through rate hikes, quantitative tightening. But one of the more supportive undercurrents looking into 2026 is the increase in global liquidity. Central banks have started easing policy. They've started cutting interest rates, tapering or ending QT. Plus fiscal policy as well, stepping in more aggressively. Think about Germany's historical infrastructure defense stimulus package. We've got the US with the one big beautiful bill. This rise in liquidity is going to help global growth through supporting asset prices, giving corporates some breathing room through easier financing, and households as well, lower borrowing costs, stronger jobs market potentially, improving disposable incomes. All of this is going to be crucial to adjust to this new trade landscape that we find ourselves in. So yes, momentum is fading, but the global economy is showing resilience, like you said, Steve. And I think, though, the real risk isn't the slowdown itself that we are forecasting. It's if we see another shock, like an escalation in the trade war, maybe a bond market correction due to the fiscal worries that we have, and the stress on the long end of the bond market, maybe another geopolitical flashpoint. If something like this hits while the growth story is already soft, that could be the big downside risk.
Yeah, great points. Just when you were talking about what's supporting growth around global liquidity, central banks on balance cutting rates over the last 12 months, but particularly fiscal support, government spending remains at very elevated levels. We're seeing that in the UK. We're seeing that in the US, like you said, with the One Big Beautiful Bill. That's a really significant driver and really significant reason why global growth has managed to hang on despite everything that's been thrown at it. And when we say everything that's been thrown at it, it's particularly this trade story. The Liberation Day, Donald Trump's very aggressive use of tariffs, not just to realign economies, but clearly just also to achieve political aims, whether it be right from the start around migration and fentanyl on Canada and Mexico, whether it be a whole range of reasons for tariffs on China. It's clearly the dominant theme and dominant risk. So do you think a further intensification of the trade war is the biggest downside risk looking into 2026?
I think it's the most significant one that we know of. The so-called grey swan event differing from the black swan event, which are those events that we don't know, the unforeseen ones that are outside the realms of regular expectation. So yes, I think that is something that we need to bear in mind, that intensification of the trade war, because that will weigh heavily on global growth over the long term. If you think that the US tariffs are now averaging over 18% already, that's the highest since the 1930s. And yes, we haven't seen a significant hit to growth just yet, but perhaps that's just because of the front loading that we saw in earlier this year to try and cushion the blow. And actually, if you look at the global trade volumes, they have since contracted, and there is we do project that they're going to shrink by around 3% from Q2 this year to Q1 next year. So look at it this way: the global liquidity, as we spoke about earlier, that's the fuel that's keeping the economic engine running. Central banks easing, fiscal policies stepping in more aggressively. That liquidity is helping to support consumption, investment, asset prices, and global growth. But the tariffs, they're the friction on the road. They're the ones that's what's driving uncertainty, obviously, but raising costs, putting inflation pressures up higher, disrupting supply chains. So even with more fuel in the tank, like liquidity, the journey still remains relatively slow because of this trade uncertainty that's lingering. But that said, though, Steve, I don't think it's all downside risk. Obviously, there's upside risk too in relation to tariffs. If the tensions ease or if they just stop escalating, that could unlock a wave of relief. And add to that, like you said, the potential of targeted stimulus or fiscal reforms. And you've got a setup that could really lift global growth above the expectations. So it's a tug of war as always, but it's never one-sided either.
Yeah, you say that growth is slowing potentially to 2.4 in 2026, but also, like you mentioned, that's slow, but it's still positive, and global growth trending around about 3% over the last 15 years. Then we're not far off. And I guess that there is a case for optimism if we see government still spending larger than usual amounts, interest rates staying low, and any kind of retreat in these trade wars. That's a possibility for a more positive year.
Yeah, certainly.
All right. So, look, we've talked about last year. We've talked about the global macro environment. Let's get down to the real deal. What really matters. You're our lead FX strategist in the UK. So, what's the outlook for sterling in 2026?
Cheers, Steve. One of my favourite questions. But, of course, let's start off by saying predicting FX is like playing chess blindfolded. You know the rules, but the board just keeps changing, and that has been evident this year. We've seen the breakdown in fundamentals, as we mentioned earlier, with the correlations between FX and fundamentals. Higher yields not always translate into a stronger currency. That's something that sterling had to deal with as well this year. We did have a first half of the year that was strong for the pound, and the technical picture has changed somewhat. I think technical and fundamental picture for sterling has changed somewhat in the second half of this year. The macro backdrop has deteriorated. We have seen, although I do like to look at the technical picture, and for next year, I think it actually looks quite interesting. Sterling dollar's held above its 100-month moving average. I'm looking at this from a longer-term viewpoint. It's held above its 100-month moving average for 2 straight months. And we haven't seen that before since the financial crisis. Even more notably, the 21-month moving average crossed above that 100 months. And that's a bullish sign of price action. That's the first time that's happened since 2003. And back then we saw another year of gains north of 7%. So maybe I'm clutching at straws here. Maybe I'm leaning on a selective historical precedent. The technical analysis obviously needs macro alignment, and whether history repeats is a tougher call, because if we compare back then in the early 2000s, the UK had much stronger growth, higher yields as well, and a supportive policy mix. Today, growth is far more subdued, but the UK does have some of the most attractive yields across the G10. So if you add in the more dovish Fed that we have right now, then you have a setup that could support sterling higher if the Bank of England holds its hawkish line, maintains credibility along with the UK's Treasury. And that is the big if, Steve. And I think it's one that could cause sterling to slip if it doesn't play out. Because if inflation in the UK cools quicker than expected, if labour markets start to soften, then markets start pricing in more Bank of England rate cuts. That's going to flip the narrative fast against the pound. Plus, US growth, as we said, is exceptional. It's reasserting itself now. The Fed's easing is mostly priced in, so the dollar could regain some strength. So maybe on its own, that might not drag sterling dollar below the 130 mark, but then layer in the fiscal concerns that we have here in the UK. The budget looming at the end of November is a flashpoint for sure. If that intensifies, you see more gilt market stress, then a move back into the 120s isn't off the table either. So I hate to be on the fence with these things, but in short, I think the setup for me, as I mentioned at the start, is promising from a technical perspective, but really fragile from a fundamental one. But that's why, our FX forecasts are updated every month, to be honest, Stephen. That ensures that they reflect the latest macro shifts and the policy signals and market dynamics best.
Well, I think you've got it exactly right there, because what we saw over the last 12 months, what we're likely to see over the next 12 months is choppiness, volatility, uncertainty, and we'll see big moves in the British pound US dollar pair. Sterling has always been one of the most volatile currency pairs out there, and it's likely to continue to be the case. So I think it's absolutely a legitimate view that we're going to continue to see big moves, big swings, and unexpected reactions in this market. It's been great to have you on here. I really enjoyed hearing what you've got to say. The Are You Ready report, I think it's just really fascinating insight to what's been one of the most substantial historical years that we've seen. The uncertainty, the volatility is going to continue into 2026, and look forward to speaking with you and the rest of the team over the next few weeks as we cover some of the other big features and themes from Are You Ready?
Yeah, that's awesome, Steve. It's been a pleasure to be on. Look forward to next time.
Thanks again. And thanks for listening, everyone. Bye-bye.